Hi, everyone. Brian Dixon here, founder of Bus Business Consultants and author of Ground Transportation Insights. In our latest You Spoke, We're Addressing conversation, we're tackling one of the top concerns operators raised in our reader poll earlier this year, insurance costs. Recently, I sat down with Alan Marr and Carter Bumgardner from Graham Company, one of the largest insurance and employee benefits brokers in the country, known for helping organizations strengthen their safety culture and reduce total cost and risk. We talked about what's really driving rising premiums, how safety culture and accountability influence underwriting, and what steps operators can take to strengthen their position before renewal season. It's a practical, eye-opening look at how to shift from reacting to leading when it comes to insurance and risk. So let's dive in. Thank you, Alan and Carter, for joining me today. It's great to see you both. I appreciate you taking the time to share your perspective with our audience on this important topic. As I'm sure you both likely know, insurance costs are one of the top concerns facing ground transportation operators right now. So I'm really looking forward to having this discussion. Alan, let's start with you. Can you share a bit about your background and what led you into safety consulting within the insurance space? And then after that, if you can just talk a little bit about your current role at Graham, how do you support ground transportation operators and what kinds of initiatives have you led?
Absolutely, Brian. Thank you for the opportunity on behalf of Carter and myself, Graham Company, and also Marsh McLennan Agency and Marsh. Really appreciate it. So a little bit of background of me, Brian. I'm a safety consultant. I started my career working for the insurance carriers, meaning like the Liberty Mutuals, Chubb Insurance, etc., before I actually started working for the Graham Company, where I've been for 13 years now. I'm a proud veteran. And also in terms of credibility, I got my knowledge starting with Liberty Mutual, then continued that with Chubb. I attained my Certified Director of Safety designation, which for those that are in safety consulting or just safety professionals in the auto space know that's a designation that really shows that not only do you have the knowledge, but you have the experience in helping to either eliminate or reduce risk. The big difference between the insurance carriers and what we do as an insurance broker, we don't like to consider ourselves as an insurance broker. We call ourselves as an outsourced risk management company, right? Because insurance is your last line of defense. So our vision and our model is to really be proactive and act more of a loss prevention or safety related perspective to prevent incidents from happening. In terms of what we've done with Graham, me specifically, I've facilitated workshops on fleet safety, auto safety. I've presented at the American Society of Safety Professionals National Meeting on the standard called ANSI Z15, which is the title of it is Safe Operations for Motor Vehicle Operations. And I've done a couple other things like been published. So that's a little bit about me with my background in insurance. Carter, do you want to speak a little bit about yourself?
Yeah, absolutely. Brian, thank you again for having us here. To Alan's point, I've been at a Graham Company for 11 years now. I'm a vice president. My technical role is as a producer, but what that really means is that my role is to go out and source new business for us and then also retain that business and help place the insurance policies. But outside of that, really act as the quarterback for our outsourced risk management model. So that would be every single one of our clients at Graham is assigned a safety consultant, a claims consultant, an account management unit, as well as two producers that oversee that. So it really is a full 360 look at risk management. And my role is to oversee that and make sure that we are providing the services as well as the client is receiving those and is valuing those. So really, if you boil it down, a lot of people would call it a broker, like Alan said, but we don't like that term because a broker just places insurance and goes out and finds you the lowest rates. Not saying that I can't do that, but our role is really more all-encompassing. And one thing to mention, at Graham, we were privately held for 65 years. We were the largest employee-owned company insurance brokerage in the country. In 2023, we made the decision to partner with Marsh McLennan Agencies, which is a division of Marsh McLennan. So we feel that we bring something that most other brokerages do not have, which is we are owned and have the ability to tap into the largest broker in the world's technology resources. And then also we have the white glove service that we bring with being a super regional broker. I think we were the 31st largest broker in the country before we sold. So a little bit of background about us, but within the operator space, I'm fortunate enough to work with some pretty high profile names within the space and have been fortunate enough to successfully place their insurance during this tough time over these last 11 years. So great to be talking to you.
I appreciate that. Thank you, Alan, for your service. And thank you both again for taking the time to talk to us today. Real quick, you mentioned that you consider yourselves really an outsourced risk management partner. Do other companies offer similar services, or is that something that's unique to Graham?
Yeah, I would say that on the scale that we have and the one-to-one client to personnel ratio, it's unique to Graham. Every single brokerage, technically, at larger brokerage, has safety consultants and claims consultants that are at the brokerage. The one thing that's different about Graham, for instance, Alan's department of safety professionals is actually 12 people that only sit in our one office. To put that in perspective, most other brokers around the country are going to have 12 people for the entire East Coast that are going to work on that. So for us, we actually are set up very differently, that we have less salespeople and more support. So true outsourced risk management to us is less producers, myself included, and more Allen's and claims and account management. So it is very unique to us, the scale that we have it, but it is not unique within the insurance industry to have claims folks and safety folks. It's just the amount of time and effort that they can put into each account.
Thank you for that information. I'd like to talk a little bit about the current state of the industry. So let's get started. And I'll ask this question first to Carter. How would you describe the current state of the insurance market for ground transportation operators?
Yeah, I would say that the current state of the insurance market is a tough one right now. Rates have definitely gone up over the last 4 or 5 years. So I'll just bucket everything together into large auto fleets. Unfortunately, most of the insurance carriers that would also write an operator, they have other segments of auto that they write. The worst segment of auto right now for all insurance companies is actually private passenger vehicles. What's the main reason for that is your cell phone, right? So distracted driving, people that are not trained to drive, such as an operator is trained to drive. And those are the people that a lot of times are causing accidents for these operators. The problem with that is that Liberty Mutual, who Alan used to work for, they can quote your private passenger vehicle, and then they also can be the insurance company that's on the operator as well. So when they look at auto liability, they're looking at it as a total number. And unfortunately, auto liability is the only line of coverage that no carrier, except for Progressive, interesting enough, has made money on over the last 17 years in a row. So there really is a push for more rate, but the problem is that they can't seem to get to a rate that makes sense for them to make money, and they have to use other lines of business to come in and make themselves profitable for an insurance company. Unfortunately, what that means is that even your best operator who was operating at no claims has been seeing probably some sort of increases. And that's really where the state of the market is right now. There are creative ways that you can get back down to certain levels of premium, taking risk on yourself, captives, things like that. But it's definitely been increases over the past years, and it's been across the board for auto.
Yeah, it feels like in the last few years, premiums have really risen exponentially. But you said that this segment of the market hasn't made money in years. So is it true that it's really just been in the last few years, or has this rising insurance premium expense been something that's going on for quite some time?
Yeah, it's really been more of a catch up by the insurance companies over the last few years. Part of the issue there is just social inflation, right? For instance, most people will know that in order to operate, you need $5 million of insurance as an operator in order to most operators probably 5, 6 years ago were buying many levels of excess liability or higher limits above that. that is really where the cost has risen. It's been less in that kind of first 2 to 5 million. Those have had exponential increases over the last few years, but before that was really where it was insulated. It's been more the umbrella liability. So carriers have cut capacity. They've gone from offering $10 million down to $5 million, for instance, for the same price. We all know that's, if you can do math there, it's 100% increase by the same thing. And unfortunately, that has to do with also nuclear verdicts. So that would be all of your massive lawsuits that you see out there. And then also just plaintiffs' attorneys. And we all see the billboards everywhere. And those plaintiffs' attorneys are being backed by private equity now, to where they are actually incentivized to go to trial, because it's been proven that if you go to trial, you actually make more money in the long run because you can get a runaway jury rather than settling and doing the right thing. I would say it's risen exponentially in the last few years, but the insurance companies have been trying their best to be partners with the operators as well, and almost stair step things, but it's been tough for sure.
My next question was going to be, is this a short-term cycle or a long-term trend? But it sounds like it's been, again, this has been something that's been going on for quite a while. It does sound like it has the amount of increase, or the rate of increase year over year has been greater in the last few years. But it does sound like it's something that has been going on for quite some time. I'll ask this question first of Alan. What challenges are you hearing most from operators right now?
I think some of the challenges that we're seeing from operators, number one is high turnover or attrition, both from the drivers and then also from the safety professionals, which are leading the strategies for the operators. That's huge, right? It's really important to have the right people in the right seats. When you don't have them there, you're just spinning your wheels. So that's one thing. Another thing is investing in technology, right? So it's really difficult to put together a cost benefit analysis, return on investment, simply because, look, if they invest in onboard cameras, it's not as simple, and Carter can chime in on this and saying, if I invest $1 million in cameras, I'm going to get a return on investment by lower insurance premiums, things like that. It doesn't work that way anymore. It's almost like the baseline for underwriters is, do you have onboard cameras? Do you have technology? If not, we're not even going to look at you. So with that, I'll turn it over to Carter.
Yeah. I think that one of the main things that I see as problems with operators, to Alan's point, is within the insurance market is making the right decisions to protect their business, but then also their bottom line. And what I mean by that is that the limits, I just mentioned, a lot of operators have cut limits, right? Unfortunately, that obviously puts their business at more risk because they're not buying as much insurance, but the cost of insurance also puts their bottom line at risk. And we all know that through COVID, operators were hit harder than most out there. So everybody's still trying to get through that and trying to get back to full profitability. And then here comes the increased insurance cost. To Alan's point, there's more turnover. There's also an aging workforce in most of these cases. So I think that that's really what we see from the operator side, is trying to find a way to buy insurance while making sure they're protecting themselves, but then also being profitable. And at the end of the day, we can sell you as much insurance as you want, but you got to run your business and you have to be profitable in order to do that.
Yeah. And speaking from experience sitting in the seat as well as working with operators today, and I think we all know this isn't the only line item on the P&L that's going up. Equipment is costing more. In order to retain employees, that's costing more. Obviously, everything is going up or has gone up over the last few years. This is just one line item of focus of many. Let's dig a little bit deeper into what's actually driving the numbers behind the scenes. So there's often a perception that insurance rates are driven only by accident history, but clearly, as we've just talked about, there's more to the story. So what factors do insurers and underwriters weigh when determining rates beyond just losses and claims?
Yeah, I'll take that to start, and then I can kick it over to Alan, because I think that's really the main thing. So losses and claims, that's really your baseline for that. But let's all not forget that insurance, unfortunately, from the underwriter perspective, is always a reactive rating. So what I mean by that is that the only thing that they're using is loss trends from the past. So you can have a new operator, new focus, new everything. And you can explain that to the insurance carriers. And if you have a good broker partner and you have a good carrier partner, they can obviously maneuver rates based off of believing that you're going to get better in the future. But at the end of the day, what they normally are using is 5 to 7 years of loss history from the past. So it's always a reactive position, and it's many years that they're using that you're going to have to fall off. So I would say rating wise, what insurance companies are looking for is probably the best way to explain it is the insurance dollar. 60% of every dollar for insurance is being put away for loss funding. So what they're expecting is that they are going to pay out 60 cents on the dollar for losses. So they're going to underwrite to that. The other 40% of that is going to be basically to keep the lights on, fixed expenses, all of safety, claims, actuarial work, all of the things that happen behind the scenes to make sure that they can run a company. How the insurance companies make money is they receive your premium, they charge you that amount based off of the 60% and the 40%, and they will then credit it based off of if your losses are better, they then apply credits. If the relationship with the broker is better, they will apply credits. And then the only other thing I would say is the one thing that we've been successful with operators is also if you're willing to take some more risk. So deductibles, right? If you raise your deductibles, you get a credit for doing that, and that would be your fixed costs. And if you control your claims, then hopefully over time, then you would have a better overall cost of risk. And but insurance companies make money off of floats, so they essentially take in the money. They're not going to pay out an auto claim for a 2-3 year period. They take in $100,000. They then put that $100,000 in the market. They make the money off of the float in the market. They're betting that if they have to pay the claims out, that they're going to make the money in the market by the time that they actually have to pay the claim out. So that is realistically what's happening. And that's why if you look at a publicly held like a Berkshire Hathaway or Travelers or Chubb, they will say that they're operating at 100% loss ratio, but they made a profit. That doesn't make sense, right? Because if you're paying out the same amount that you're making in, you can't make a profit. They're making the profit on the float of the market. So if you boil it down to that's how the sausage is made. And it really depends on also geography, what type of runs you're doing. So line run versus charter, who are you transporting? Is it school versus charter versus limo versus others? So there's different rating metrics that are all over the place. Are you in New York? Are you in North Carolina? So there's a lot of different ways that it works. But fortunately, I think for the operator's sake, some of it is in your own control. The type of deductible you have, the type of broker you have, and then the type of focus you have on safety and claims. And that's where I'll turn it over to Alan for kind of his thoughts on the safety and claims portion.
Yeah, great thoughts, Carter. The one thing I wanted to chime in on is the strategy behind the higher deductibles. So as Carter alluded to, higher deductibles come with higher risk, right? So the insurance carriers are going to conduct their due diligence, and they want you to have a solid auto or fleet safety program in place to even have those type of discussions, right? So you can't just fluff your way and say, yes, we have a fleet safety program in place and things like that. Like you have to really get down into the weeds to make them feel comfortable. And every question that they ask is very much intended to get to the weeds, start peeling the onion to see if you really are a good risk. If not, then they're going to underwrite you as much. So I just wanted to chime in on that. But I think some of the factors really is technology. Like if you're not investing in technology these days, you're going to be left behind or not even be looked at all. That makes it much more difficult for Carter and our colleagues to test the market. So that pool, it becomes a lot smaller. And then when it becomes smaller, you lose that leverage. And Carter's not going to be able to advocate on your behalf and give you better rates. So technology is definitely key. And I'll talk more a little bit about that beyond the onboard cameras. Also just doing the tactical things such as pulling motor vehicle records, right? How often are you doing it? Who is doing it? Do you have an adjudication process in place? Meaning if Brian has 2 preventable incidents or crashes within a 24-month period and he's got 5 safety violations, speeding, et cetera. What does that mean? Are you just pulling MVRs to pull MVRs, or are you actually holding Brian responsible and then our company accountable to do something about it. Some folks don't like using the word accountable. Maybe it's extreme ownership, as Jocko Willink says. But regardless, we have to make sure that we take the bull by the horns and execute. So I think technology and MVRs are two factors that should be discussed further.
That's a great point. At the end of the day, that's on the operator to acquire that information via the MVRs, but then to act on it. And I would say, even in my own experience, one of the challenges I see is operators actually acting on the information. You talked about accountability. That's really in my mind how you manage your risk is, okay, I've got this driver that has demonstrated a pattern of whatever the case may be. Now, what am I going to do about it? And it's tough because, as you talked about earlier, the revolving door of drivers, and you're now just going to make that worse if you hold that driver accountable. But in my own experience, I have seen that small situations begat large situations. And oftentimes there are flags that if you see those flags and you take care of that situation, unfortunately, oftentimes that means maybe separating the driver. You avoid those large incidences. Who knows for sure? None of us have a crystal ball, but I certainly know that on the flip side, if I've kept someone who had small incidences, more than once I've seen where it turned into a large one. And I said, wow, I could have avoided that if I'd separated them a few months ago, and I didn't. And now look what happened.
Absolutely.
We talked a little bit about this. Carter and Alan, if you can both just share your thoughts on how do things like safety culture, preventative practices, and also external forces like litigation. And you talked a little bit about the litigation earlier, which I didn't know that some of the plaintiff firms were owned by private equity. That explains a lot. But things like litigation or just the broader economic conditions are influencing premiums.
I'll start with the culture and preventive practices, and then you can chime in on the external forces, Carter. It's not just safety culture, Brian. It's really culture, right? Because safety culture, you're almost like saying it's just about safety. It's the entire enterprise that the operators need to understand. And it really starts with having an executive sponsor, right? Somebody that can really support the efforts, the loss prevention efforts. That's a term or a phrase that we use, Brian, for safety, right? Loss prevention. We're trying to prevent incidents. Remember, insurance is their last line of defense. When you don't have an executive sponsor to really support the efforts of your team, you're really cutting the legs from underneath them. And when you don't have that ability to help push the culture to the next level, the drivers will see that, the employees will see that, and it'll be just another monthly shiny new object put into place just to say that we're working or focusing on culture. So it's really important that you start there and lead by example. And as far as preventative practices, that's super important as well. But to Carter's point, I'll get into a little bit later on, is establishing a baseline of your overall fleet safety program or auto safety program. And you have to almost start with the compliance side, Brian, but eventually as your culture progresses, you move more from a reactive to a proactive sense. Right? You start talking about driver recognition programs and things that really focus on the positive things that are being done by your operation drivers versus the Carter, this is his 5th time having an incident this month. Let's go after him. It's not all about that, right? So you have to focus on the positives as well. So with that, I'll turn it over to Carter to talk about the external forces.
I think we hit on it before. I think that the external forces are the same as everything else that you've seen, right? On the other thing is that when the cost of everything goes up, so does insurance, right? So within auto liability, within an auto policy, there's 2 factions, right? So there's the auto liability, which is third party. You also have physical damage for your operators. If a fender bender used to cost you to replace a bumper $100,000, let's say $20,000 back then for a true charter bus, then now it's costing you $50,000. The insurance companies are noticing that. Right. So they are going to rate it with the cost being higher, because when you file that claim, and if they rated it based off of it's only going to cost 20 and now it's 50, now they are not profitable. And the one thing I would say, Brian, that I think that people have to understand is that this is not, when it comes to insurance companies, they are for-profit organizations. They are most of the time listed on the stock exchange, and they report to their shareholders. So while their main fiduciary duty is to the insured, they also are here to turn a profit. I'll give you a quick example, not related to operators, but down in Florida, DeSantis tried to put in something that said that all of the insurance companies have to cover the wind in Florida at a certain rate and for everything, or they can't be here. And what happened? I'm sure you may have seen it in the news. All of these for-profit companies said, then I'm not going to be here. And they all left. So there is not, everybody has to understand that that's one of the things that's driving things in the back end too, is that they are looking at the profitability of themselves, and auto liability has continued to go up, nuclear verdicts, all of those things. But it's everything's more expensive. Now, I will say there is a lot of opportunity out there though for operators to take more risk, because as your premiums go up, the opportunity to get more credit as you take more deductibles or as you take more risk yourself, look at captive program, things like that become better. Easy way to put it is if you were paying $500,000 in the past, let's say 10 years ago, you would never take a $500,000 deductible if you paid $500,000, right? That makes no sense. But fast forward, if now you're paying $1 million, maybe you would take a $200,000 or $250,000 deductible to make that go from $1 million to 600. And then you play the game of will my claims be less than the credit that I'm getting? So that, I think, is one of the main things we're seeing. And the rise in insurance costs has allowed that to happen more.
Thank you. It's been eye-opening for me. I've learned a lot just in that part of the conversation. Let's shift more to what operators, how they can respond and what's within their control. And we've talked a little bit about that, but I'd like to dig a little bit deeper in that. So my first question is, what steps, whether through safety practices, technology, or risk management, can operators take to reduce their profile and strengthen their position with insurers?
Yeah, first and foremost, insurance is still a relationship business. This is not, when we said there are true underwriters of people, and so are the people that they report to that make the final decisions. So the one thing that I would say is you want to have a broker partner and a carrier partner that want to write your business. The more data that you can give to your broker in order to put you in the best light, the better. But the other thing that has been very successful is that if you have, in this space, we all know that there's not 50 carriers that are out there writing this type of business. So if you're boiling it down to 2 or 3 carriers, the one thing that's been very successful for us is let's get in-person meetings with the insurance carriers, not just the broker selling the insured, but the insured themselves going to the carrier and explaining that, hey, I'm sitting you across the table from you, underwriter and person who makes the decisions at the insurance company. And I'm telling you, and you can look me in the eye and see that I'm a good person, I'm a good operator, and I'm going to be a profitable risk for you. Because insurance companies only deviate from their online system and their online rating if they feel like you are going to be more profitable. And the only way that you're more profitable for them is you have less losses than the premium that they bring in. So that, I think, is one way to differentiate yourself, is you have to have a broker partner that understands the market, can advocate on your behalf, can bring you different types of programs. But at the end of the day, in my role, if I can get a really good operator to explain their story, their history, why they're the best to the insurance company, then that insurance company is going to want to do business with them. Because right now, outside of that, they're just a stack of 20 of the same operators that they got it in a submission about. So that's something that I would say they could take more control of, is go to your broker, go to your partner and say, I'd like to have a meeting with my underwriter, and talk to them, see if you can get to know them, because that's what you want as a partner.
Alan, any thoughts on what steps operators can take to reduce their profile and strengthen their position with insurers?
Absolutely. From a auto safety practices perspective, Brian, it's really simple. It's a 3-step process. Number 1 is you want to baseline your overall fleet safety program or your auto program. Really, really important. Step 2 is then to conduct a gap analysis or a risk assessment. And then step 3 is the execution piece, meaning initiating the improvement strategy. And when you baseline your safety program, there's a couple of different areas that you want to focus on. So you have One area is management, leadership, and administration, right? So you have to be able to baseline that. You also have your operational environment. You have the drivers, you have your vehicles, and then lastly, you have your incident reporting and analysis. So where you're able to baseline that to really establish where you're at, then you can conduct that gap analysis, right? It's the risk assessment. So what you're doing there is comparing compliance versus what we call better practices. And notice that I don't use the term best, Brian, because I don't think there's such thing as a best practices, right? Because it's all about continuous improvement. So I call it better practices because you're constantly evolving. So once you do the baseline, once you put together a gap analysis and risk assessment to get you to the next level, then you execute. But that baseline, that gap analysis or risk assessment, it's really a roadmap, Brian, for the next 10 years, right? So everybody talks about what are you going to do for the next year, 3-year plan, 5-year plan. It's a 10-year plan, basically. And then the biggest part or piece is the execution. It's really important that now that you have your roadmap, you execute. One of the things that Carter talked about is the nuclear verdicts, right? So you have these things in place, you have technology. I know that was one thing you wanted to talk about. The biggest issue that we see with technology is folks not using the data that the technology produces, right? So you have all these incidents or near misses, things like that, and it's just sitting out there. If you get taken to litigation, they're going to see that. They're going to say, Brian, you have all this data, you haven't done anything with it. So if you're not going to do anything with it, then why even have technology? Because it's going to be used to get you in the court of law. So I think, having the 3-step process, the baseline of your police safety program or auto safety program, conducting the gap analysis or your risk assessment, and then executing is what you need to have in place.
Now, just a couple of follow-ups on that. First of all, I agree with you. I've said that to operators myself. I said, having it and not using it is worse than not having it. Not only are you paying for something that you're not actually using, but you also are increasing your risk exponentially, like you said, during a discovery process. And you talked a little bit about baseline, but for folks who may not understand, when you say baseline, what are you talking about?
It's about evaluating what we call your control measures, right? It's a couple of areas that I've mentioned. One is management, leadership, and then administration. So what kind of leadership you have, right? It's really important. Do you have the right people in the right seats? Really important to have that. And then on the administration side of things, Brian, do you have documentation, policies and procedures in place? So are the guidelines? So if you don't have those things in place, that's an issue, right? So you have to baseline, meaning where you're currently at. When you baseline something, is basically taking a snapshot of the current state of mind, the current place where your programs are at. So that's one area. In terms of operational environment, like what's your footprint? Are you focusing in the 5 boroughs of New York City? Are you in remote areas? That's another area. The drivers themselves. So what's your onboarding process for your drivers? Are you outsourcing training? Are you doing it in-house? Do you have more tenured drivers? Are they newer? And then also having discussions with the drivers themselves. And then your vehicles, or as we like to call them, power units. So that's really important. And everybody thinks that it's just buses. What about your power units that are not falling under the jurisdiction of the Department of Transportation? Vehicles that are less than 10,001 pounds, they're not considered commercial motor vehicles. That's also an exposure that Carter has to deal with the clients. Often overlooked, Brian, but is it an exposure? Absolutely. Or how about your sales folks that are driving their own personally owned vehicles for business purposes? So that's another exposure that's often overlooked. And then also rental vehicles, right? Maybe your bus is down and you have to rent from somewhere else. Now you may not have the onboard cameras in place. You may not have the proper technology in place. You have to look at that as well. And lastly, incident reporting and investigation. How are you actually reporting it and going from cradle to grave? Reporting incident to incident investigation to having a review committee that collectively decides whether or not the incident was preventable, and then going to next steps. Again, holding folks accountable, not just drivers, but middle management, upper management, It's really the cradle to grave. So that's what we mean by baselining, Brian, is really
Understood.
getting into the weeds.
So it's really more a kind of a state of the state. Here's where we are today. Then the gap
Yes.
analysis identifies where you should be versus where you are. And then, of course,
Correct.
the execution is the plan to get there. Got it. Okay.
Yeah.
Thank you for that.
Before we jump off, the one other thing I would say is that everything that Alan just said there, all the things that you can put together if you have a partner that really is focused on safety and for the operators, all of that is used with the carriers by myself in order to get better rates. And we feel like the carriers know that that they can give us better rates because we are going to jump in and help with that. I feel like a lot, unfortunately, within the operator space is just very transactional. And two, we all want to pay the least amount of money, but I feel like it's very transactional. And to have somebody like Alan to be assigned to an account and to be able to help with that helps me tremendously because then there's proof there. Like, would they have a best in class safety program? Let me show you why. Instead of me saying they have a best in class safety program and they look at me and say, oh, another sales guy who says that they have the best in class safety program. Awesome. Check the box, not listening, move on. So I think that is something too, for operators, is to make sure that you're getting the most out of your partners. Brokers should be providing it, but so should carriers. You pay carriers a premium. Part of that should be they should be delivering you services to help you, because if they help you, you're helping them. So I think sometimes, and Alan can speak to that a little bit if needed, but we feel like that's overlooked a lot of times, is people don't want to reach out to their insurance carrier for help, but they have a lot of resources, they have a lot of money, and they can help. So I would say that's another thing that differentiates yourself, to your point. So
Now, are the services that Alan provides, is there a fee associated with that, or do those come along? Are those covered by your premium?
yes, from our perspective, it's covered by whatever the compensation agreement is with the client. So that can be either through commissions, through fees for service, through a combination of both. The way that we look at it at Graham is that whatever we come to an agreement on from a compensation perspective is actually going to be, we provide all of our services. Now, there are certain things that are outside of that, but generally that's the way that we look at it. And a lot of times it can be either through commission, through fees, or through fees that are based off of outside of the premium. It could be based off of miles, based off of units, a lot of different ways. But that it's really more of a negotiation on what the client is looking for.
All right. So we talked about some things that operators can do. What are some common mistakes or missed opportunities that you have seen with operators?
The biggest thing that I see, Brian, is the lack of execution. It's really important that once you have a plan of attack, a plan of action, that you go ahead and execute. And not having a strategy behind the execution piece is big also, Brian, because there's strategic initiatives, but there's also tactical, right? And what I mean by that is the strategy behind it is it's for the entire enterprise, right? So for the operators, and more the tactical or the things that really get into the weeds. And you have to have small wins also, Brian. So if once you conduct that gap analysis, you have a list of 15 things you want to do, you want to try to do one or two things, right? When you try to put too much on your plate, things don't get done, and then you're just spinning your wheels, right? So you have to look at it from both of those angles to be able to do. And part of that execution piece, like I said before, is having that executive sponsor to really help you drive, right? And you cannot just put it on the drivers, right? It's got to be middle management, and it's got to be upper management as well. Again, extreme ownership is really important. And how do you do that? Is by having clear roles and responsibilities. That's always where I start. If it feels hazy or gray and people don't know if it's me or it's Brian Carter, that's where the issues happen. And that's where I see a lot of clients going wrong.
Yeah. Unfortunately, in more than just this, if multiple people being accountable for something means no one's accountable for it.
Correct.
So, well, this has been a great conversation. I just have one more area I'd like to talk about, and that's really what the future looks like. So as you both look ahead, where do you see insurance cost and industry risk heading over the next few years?
Yeah, I can take that one. What I see in the next few years is I see opportunities for insurance carriers to partner with the operators. Now, I'm going to pull that back and say that auto liability is still going to be tough. What we need to do as a nation for automobile liability is we need to crack down more on the cell phone use, the private passenger vehicles, and the fact that people can drive without insurance and do all of these things makes it really tough for insurance carriers to not charge at least the same, if not more rates in the future. But I believe that there's opportunities in other lines of coverage as well that we didn't speak about. Workers' compensation is a line of business that is a decent line item for most operators, and that insurance is actually going down right now, as long as you are having good claims. So a good broker partner should be looking at it on a total cost of risk standpoint. And then the other side is I see hopefully the nuclear verdicts will come down in the future. Hopefully the court system will get a hold of that. I know that the insurance industry is fighting very hard for that, and that hopefully will turn the umbrella and excess market as well. But I would say in the near future, if you have a really good loss history, you have a good broker partner, you should be getting lower rates than what the market is giving. But is it going to go down in the market? I don't see that in the next couple of years, just broadly for all auto. And this isn't just operators. I'm talking about between Alan and I, we have many clients that have big fleets that do a lot of different things. So it's not just bus, it's really just auto as a whole. Even our own personal autos, I wish I could go get my premium to go down, and I sell insurance. That's really what I see. I don't know if Alan has any thoughts in the future.
I do. And I think you brought up a great point, and operators often see this as a minor thing, Brian, but it's just the distracted driving, right? With the cell phones, that's just one component. Even if you don't have a cell phone in your hand and you have Bluetooth, Brian, and I know for a lot of companies, they've made policies where you're not using a cell phone period, you have to pull over, et cetera. But they think we have a policy in place where you can't be speaking. Even if you have your hands on the wheel, even if you have your eyes on the road, your mind's not there. It's called cognitive distracted driving. How many times have we all been on the road and we're having a discussion and you're like, what just happened for the past 5 miles?
How did I get here?
No idea what's happening.
Right. Missed the exit. Yeah.
Yeah.
And then exactly. So Carl, you missed the exit, or now you're trying to make the exit and you're crossing 3 lanes. Like, it's just insane. And that's just yourself. That's not even the rest of the population out there doing their own thing, putting on their makeup, shaving, sipping on coffee, whatever the case may be. So you have to get to that level of detail to be able to make a difference, or else you could be susceptible to those nuclear verdicts.
Yeah, absolutely. Just a few more questions. Carter, what are some creative strategies that can help companies better manage rising costs? And we've talked about some of these already, but just to put a bow on it, or if there's perhaps something you haven't mentioned already, what are some creative strategies that operators can employ?
Yeah. So just real briefly, number one would be focusing on the market that you're working with. So a lot of times, if you're only working with the incumbent carrier, which is the carrier that you have right now, that's good. You want to build a long relationship with them, but there's nothing wrong with testing the market every 4 or 5 years. Even as the broker, if you're not going to leave, people understand that it's a for-profit insurance industry out there. And sometimes you will catch a carrier asleep at the wheel, basically. That's a bad pun on this call, but that's number one. From a creative standpoint, what we've seen as being very helpful is at your next renewal or leading up to the renewal, you should do a total cost of risk analysis and then get a couple of different quotes. And I'm going to bucket that into a couple of different ways. Let's say that you have a $25,000 deductible right now. What you can do is you can get quotes to go to 50, go to 100, go to 250, depending on the size of your premium. And you could go all the way up to $1 million or higher, depending on your premium. And then look back and say, using those same 5 to 7 years that the carrier is using, what was my cost underneath those deductible layers? And what credit am I getting for that? So for instance, if you're getting to go from 25 to 100, that's $75,000. Let's say that you only paid over the last 5 to 7 years, you averaged an extra $40,000 in that layer of 75 for claims every year, but you got a credit of $80,000. Then it's a good deal as long as you maintain or do better than in the future than you did in the past. And there's nothing wrong with getting those quotes. That's the other thing I always say is I'll present you all these different options. It's your risk tolerance that makes the most sense. And the other one is captives. That's really a buzzword out there. So there's three different types of captives. There's a group captive, which there are great group captives out there for operators, whether it's school bus or charter. But a lot of it depends on your geography, your size, all of these different things. They won't let everybody in. It's a check the box. But that's a great way to take more risk. Set your basic, just to put it in perspective, instead of taking the deductible credit and then paying losses as they come, you actually fund in losses up front. And then you create dividends off of those funds as you pay losses. So again, same thing though. If you fund for losses and you pay less, you are now the insurance company. You make money on the float. That's how a captive works. But for some of the larger operators, I would say that that something that is not being utilized in the operator space that is being utilized in large auto fleets for other businesses out there is rental and single parent captives, forming your own captive, taking that insurance company float, all of those things away from the insurance company and really betting on yourself. And as a part of Marsh McLennan, we're the largest captive broker in the world with the most amount of rental and single parents. And I think that's something that is not being utilized and looked at enough by operators. You don't have to go and do it, but I don't think that they're even looking at it. So I think that's the most creative way that I would see moving forward as insurance costs keep rising. Instead, form your own insurance company if you're large enough to do it and just pay the losses, because then you don't have premiums go up every year. It's really, did you have losses or not? So but that's probably another full discussion, to be honest.
I was going to say that, that sounds not complicated, but it sounds like something that requires some additional conversation. Alan, were you gonna add something to that?
Yeah, and to Carr's point about being in a captive, being a strategy, create a strategy. Number one, your business partner, your outsourced risk management company needs to bring it to the table, right? They have to educate you on that, raise awareness of it. But being in a captive, you can't just be in a captive, right? So you have to be good. You have to be really good, right? Because you're sharing the risk with other companies, potentially. So they're going to do their due diligence on you. Again, what does your comprehensive motor vehicle safety program look like, right? So if you don't have the right pieces there, they're not even going to look at you, right? So that's not even an option. So you have to build your program and your culture to get there, to even have that as an option. So I just wanted to chime in on that.
Yeah.
I think that's an important nuance.
Yeah, the safety and the claims is the most important thing there. But the one thing I would say about a captive is that if you get there, and to Alan's point, a lot of partners are not pitching that because really they can't set it up and they don't understand it as well. So it's easier to just move away from that and stay with the status quo. But the other part is that you really need a broker partner that can provide the safety and claim support, because now that really is your money. It's not the carrier's money. That is your money that you're going to put out front. And I will say the one positive about that is every single captive that Alan and I have set up, you've never seen C-level executives focus more on safety and claims than when it's their money that's sitting over there instead of Liberty Mutual's.
I'm sure that'll get their attention very fast. It sounds like really this renewal process or this engagement with your broker or your carrier isn't something that you just wait until a couple of weeks before your policy is expiring and you pick up the phone. It sounds like you need to engage fairly early in the process. So what's an ideal window to give operators the opportunity to really, as you said, to comparison shop? And maybe that's not something they're doing every year, but every couple of years, what's a realistic window before it's time to renew for you to engage, and gives the broker and the carriers time to run the numbers, but then also gives the operators time to review everything and make a decision?
Yeah, absolutely. Probably the easiest way to answer that is just to walk you through what our process is. What we do is let's say that I'll work backwards off of this. So let's say that you have an October 1st renewal date. We just renewed. What we will do is 6 months from now, we will set up a stewardship meeting. That stewardship meeting is actually with the incumbent carrier and ourselves and the insured to talk about, hey, how are things going so far through the year? What are we looking at? Get a pulse on the market from your current carrier without going out to other carriers. After that meeting, 2 months later, so 4 months before the next renewal, we have what's called a pre-renewal meeting where we sit down, just us and the insured, and say, hey, what do we want to do this year? What are we looking at doing? Are we going to go out to market? Are we going to bring many different deductible options? Do you want to look at a captive? What do you want to look at for this year? And then 30 days from that, we gather the information that's needed. If there's more information that's needed, depending on deductibles and where we want to go. And I'd say about 90 to 120 days before the renewal, we're out into the market. That gives us about 60 days to market the program, have carrier meetings with the insured, and then about 30 to 2 weeks to 4 weeks before the renewal is when you would present the options, make a decision, and then move forward from there. So that's really that's what we do for all of our clients. And it's a high touch system, but it allows you to make a decision, because the other thing is there's going to be operators that, hey, everything's going great. I really like my carrier. If they can keep it at a 2% increase for this year at the pre-renewal meeting, then, I've got 80 other things going on. I'm not going to go through this year. So then our job is to go and get that done and then bring it to them 90 days before. And then everybody says, sounds good, we're moving forward. So if you want to do it every year, because it's not going to happen every year.
That's great insight. For both of you, I'll ask this last question. If you could leave operators with one piece of advice about managing safety and insurance today, what would it be? I'll start with Alan and then Carter.
Yeah, thanks, Brian. Excellent question. I would say human capital, right? It's about having the right people in the right seats. And taking it one step further is asking the questions such as, do they get it? Do they want it? And do they have the capacity to get it done? And then comparing those people against your core values, right? So they may meet those things that I just mentioned, but if they don't align with the core values, then you're just spinning your wheels again. And like I talked about before, along with the human capital, is having that executive sponsor. It's absolutely critical to make sure you have that. It really starts there, Brian, and then you can execute.
And by human capital, we're not just talking about the drivers in the seats. We're talking about the folks who are administering the safety program, the operations folks who are leading the drivers, who are on the front lines of many of these situations. We're talking about all of that, in addition to the senior management team. Is that correct?
Absolutely. You want to look at it from a military perspective, right? Again, being a veteran, it's the same thing, right? It's like you have the generals up top. They could be putting together the missions and the vision of what they're trying to do to win the war and in the battles. But if you don't have the middle management, right, the non-commissioned officers and the officers really helping to execute, then you're still failing, right? So it's got to be a collective effort from all different levels.
Yeah, absolutely. Carter, what's one piece you'd leave with operators?
My one piece would be complacency kills growth. I think that status quo within the insurance industry is, from the brokerage side all the way to the carrier side to the insureds themselves, is what is killing growth. I think that every single year you should be evaluating your insurance program. That doesn't mean that you're making a change to the brokers or the carriers or anything in the program, but I think that there should be an evaluation of, what does my company look like now? What does my financial structure look like now? What does my losses look like? And does that allow me to look at different program structures that might be a fit for me, whether it's for this year or for the years in the future? And I think that, unfortunately, the easy button is the easiest thing is by far the best thing to press for all brokers, all insureds, and all carriers. Oh, here's your 10% increase. Didn't leave me. I'll take my commission. We move on. See you in 9 months. And I think that is what is broken in our industry. And at Graham, we do not accept that. We do not work with that. And we 100% look at every single year as an opportunity for growth in the insurance program. So that would be the one thing I would leave is, don't get complacent. And again, it's not a commercial to change your broker. It's a commercial to say, just make sure that you're looking at your program and your partners are looking at your program every single year, because things change and there's new things out there every single year that are available.
Absolutely. In this economic environment, I would imagine that many operators are taking a hard look at every facet of their business, but certainly as insurance, that insurance cost becomes a higher percentage of revenue on an annual basis. It's going to require and command more attention, but that's great advice. Thank you both again for sharing your insights and your experience. I certainly learned a lot today, and I know this will be valuable for the audience, many of whom are navigating these challenges and looking for ways to strengthen their safety cultures and control their costs. Thank you both again for your time, and look forward to talking with you again soon.
Thank you for having us, Brian.
Thank you, Brian.
That was my conversation with Alan Marr and Carter Bumgardner from Graham Company, and I think their message was clear. Controlling insurance costs starts long before renewal season. It's about taking a proactive approach, building strong leadership habits, fostering a culture of accountability, and partnering with your insurance team year-round to strengthen your position before renewal. This conversation is part of You Spoke, We're Addressing, where we continue to tackle challenges that matter most to operators. If you'd like to explore how these strategies can apply within your own organization, I'd love to connect through Bus Business Consultants. Just reach out at brian@busbusinessconsultants.com or visit busbusinessconsultants.com. Thanks for watching, and I'll see you again soon.